It's one tool in your tool belt where you can access pretty much an unlimited supply of capital.
That's Justin Foster, who built an impressive small and mighty rental portfolio, but he's also a hard money lender who helps other investors get money for their deals.
A hard money lender is just somebody who lends money as a business and they secure it by collateral in real estate.
In this episode, you'll learn the importance of locking up a good deal first before you try to get the money.
You could glance at it and say, get it under contract like yesterday, and then we'll figure out the money this week.
The challenges of hard money.
The cost of the money is the highest with hard money. And so you're paying a premium on interest for the speed and the convenience.
And the 4 C's to ensure you get approved for hard money loans.
The first thing would be the collateral. I'm interested in working with people who have good character, cash in the deal.
What's C number 4?
The last one would be.
And now we're going to dig into all of that and more. So Justin, I want to give you a real life scenario where let's say you are a rental property investor, you're in the growth mode, and you just bought a rental property last week, and you used every bit of your financial ammunition that you had, your down payment, and then some, all the repair costs. Like you've got zero cash left. But then this week, like a week after your deal you bought, the deal of a lifetime comes in. And this is like in the bullseye of your place you like to buy. It's like a perfect type of property. And not only that, like the seller is really motivated and they're like, I just gonna get rid of this property. And you can basically buy it at about 60% of the full value all in, like including repairs and everything. So, I mean, this deal is just the best you've ever seen, and you got zero money. Let me start with that scenario and say, all right, Justin, Mr. Entrepreneur, investor guy, like, what goes through your mind on how you could actually do this deal? Do you walk away because I don't have any money, or what kind of solutions do you start thinking of?
I love this question. I love when investors get to this stage in the game in their builder phase, because inevitably, I think unless you have like millions of dollars, which I didn't, and when I started investing, you're going to run out of money. And the answers are really, really simple. And there's really good solutions when you have a good deal. So the first thing that I would think about in this market, what market am I in, Chad? Am I in a good sized market in Tulsa, Oklahoma, or?
Yeah, go Tulsa, okay. Oklahoma, although this could apply to really, any metro area that has decent size.
So I would immediately go to the real estate investors meeting that month and shake hands and be looking for people who lend out money for a business. And they would want to partner with me as debt and fund my either fix and flip or buy and hold. And that's how I would take down that deal. I would also go online and I would Google those people and I would call them up. I would fill out the simple 1-minute application that they have and say, hey, here's my deal. This is the collateral. Give me a call. I would get on the phone and I would talk to a handful of hard money lenders to see if I could find somebody who would want to do that deal with me. And based on the numbers that you're telling me, I would imagine if I called 3 people, I'd get 3 offers and be able to take that deal down that week.
All right, good. I want to unpack some of this because you've used some terms, you've used some different avenues, which I love. That was the practical solution here. But I want to put an assumption there just for everybody listening to this. I assume you would also just go put that property under contract right away. Like you wouldn't wait to go to that meeting to talk to the people before you put it under contract, or is that right? What's the order of operations there?
Right. I mean, if I had my ducks in a row and I knew I was out of money, a month before, then I might have sort of had a conversation and seen the process of what it would be like to partner with somebody where they're bringing the money and I'm bringing the deal. So, but if I hadn't had that, when in doubt, Chad, I like to do the aggressive thing, get it under contract. If it's a deal, it's going to be there for less than 24 hours. So you really need to lock it up, 60 cents on the dollar, and then have the money conversations. And that one would be a situation in which I don't have to have a lot of experience. I could borrow from your experience. You could glance at it and say, get it under contract like yesterday, and then we'll figure out the money this week. Okay. So that's absolutely the thing to do, get it under contract in my mind.
Yeah. And so obviously every little situation is different, but one of the cool things about real estate is it's not like the moment you choose to buy a property, you have to come up with all the money. There's these little stair steps of like, each step you go a little bit more committed, a little bit more committed. And so this is something you talk to your local attorney about, but you could have a contract, for example, with a due diligence clause that
Mhm.
says you have maybe 7 days, maybe it's 3 days, maybe it's 2 weeks, but it's typical to have some sort of due diligence clause where you say, hey, if I inspect this property or if I do my due diligence and I need to back out for whatever reason, you can get out of the deal. And in some cases, you have some money's on the line. You might lose some earnest money. Some cases you don't, but that's what we're talking about, right? You at least get the deal under contract, figure out a way to don't let that fish get off the line. And then now I want to dig into, you've mentioned some things like you go partner with somebody who has the money, you go find somebody else to put up the money and you bring the deal. So there's this idea that if you have a good deal, then the money will come to you. And so you've mentioned a few different solutions. I want to start with hard money because this is one that's probably the most plentiful source of money. Is probably the one that's going to be the easiest find. If you Googled hard money lenders, if you looked up in your area, there's going to be a lot of hard money lenders out there. But let's go back to the 101 level. If somebody's like, well, how am I going to come up with the money? What is hard money? Like, what does that mean? Who is this source of money out there that's available?
Yeah, that's it. I don't like the word hard. I don't know who came up with hard money. Hard money lender is just somebody who lends money as a business, typically, and they secure it by collateral in real estate. So those are professional lenders, but a lot of times they're guys like me, guys like you know, small family offices, local investors that are in their community, they understand the market, and they're, you know, individuals or small companies that are playing the bank. And in some situations there are institutions that do hard money lending, but by and large the market share goes to really kind of small and mighty hard money lenders and
Mm.
folks that are, you know, have a portfolio of loans and they like to be on the money side of the real estate business more than anything else, or you know, that's the focus. So um, yeah, and you can partner. I say partner. It's not, maybe that's not the right word, but you can work with those money people in their business to pair up with your business to be able to fund your deals and bring the money that you need to take them down and solve for that. So it's one tool in your tool belt where you can access pretty much an unlimited supply of capital and have multiple lenders that you reach out to and are working with to be able to fund your portfolio and your builder phase.
Yeah, I like that. I want to build on some more benefits. So the keyword I heard was unlimited source of capital. So like this idea that if you run out of money and you want to keep growing as a real estate investor, you got to get some source that's not going to run out. Like we have a limited amount of money. We all run out. That's just the way it works, whether it's one deal or two deals or 10 deals. And so there's just a bunch of hard money lenders out there. There's virtually unlimited amount. That's a benefit. Something I want to mention a couple other benefits and feel free to chime in as well. The benefit of not being like a typical bank that looks just at your income and your personal credit, although I think some hard money lenders would look at credit, there's a different qualification process where they're looking more at the property itself. They're looking at your ability to actually buy this property and pay them back. So there's just, I want to call it an easier qualification process than compared to like going and getting a conventional loan where you're just putting, a huge stack of paperwork and a 45-day process and all that. So ease of qualification. And then just the fact that they can close quickly on the type of deal we just talked about. Like let's say that seller's like, I'll sell it to you for 60 cents on the dollar, but I need you to close like 2 weeks from now. Like,
Easy.
here
Yeah.
they could do it, right? A hard money lender, a
Yes.
private money lender is used to doing these really fast closings. They can make a quick decision. It's not a committee up in New York somewhere, an underwriter with a bunch of layers. This is typically like an individual, a small group, a small business. They'll make a fast decision. Is there anything else I've mentioned? Like that speed and the ease of qualification really comes to mind for me. But what are some other benefits if somebody's like, I should consider using hard money?
Well, those are really good ones because time kills all deals. And a lot of times it's under time pressure that people see hard money lending as a benefit. So for instance, I don't need an appraisal when I get hard money from somebody. I can just trust that, you know, they're going to be lending based on the value of the property once it's fixed up. And we agree to that value and I get a term sheet that's really straightforward and simple. So there's a simplicity to it as well. You know, the note or the mortgage or the deed of trust isn't always like this thick, right? It's a few pages, and it's pretty straightforward. Another thing that I guess is some creativity and some flexibility as well, potentially on either the terms, what kind of collateral, additional collateral you might be able to bring to the table. Maybe you don't have cash, but you have some other assets. Like if you're really cash poor and you have equity in real estate, you can actually leverage that equity in real estate sort of as a down payment form or extra cushion to make them feel good about doing a deal very quick with you. And but also some terms are negotiable. One of the things that we do when we lend out money is we accrue the interest and the points. So you don't pay us until the very end once you refinance or you sell the property. And that alleviates the pressure and simplifies the process of servicing the loan. And so there's other creative things that I could think through, but there's a lot more flexibility as well, Chad, and that's helpful to taking down more creative deals and working with investors that are going to understand the market, understand what you're looking to do, and come alongside of you and help you get to where you want to go.
And that flexibility depends on the lender too. Like you've done
Yes.
loans. I've done a few hard money loans here and there. There's just a ton of different people who do different loans. And so there might be one person who says, yeah, I'll let you accrue interest like you do. Another one might say, I'm not going to let you accrue any interest. You have to pay it every month, but I won't make you put any down payment. They might not have any skin in the game. So that's a pretty cool thing. Like you can, typically when you go to a bank and you get a conventional loan, like there's a box there and you don't get outside that box. Like the terms are the terms. They use the same mortgage every time. The flexibility of a hard money lender is really another benefit, right?
And I would say this shouldn't be understated. There's four things that we look at when we do a hard money lending deal, and call them four C's. Okay. The first thing would be the collateral, like this asset that you're taking under contract, that you're going to purchase, rehab, fix up, and then refinance into. Is that something that I would want to own? I'm doing this in my back market, or in my backyard, in our market, and so I kind of understand our backyard, and we care about the collateral. So we look at the collateral, and you can pretty well count on giving a hard money lender a first position on any collateral that you're looking to get under contract as a good rule. But there might be some flexibility for some lenders, but the majority of the time they're looking to protect their money. So keep that in mind. The
First
second
position,
thing,
I'm going to interrupt you. The first position meaning like
okay,
there's no other mortgage ahead of you. Like some people like a home equity line of credit is often like behind another mortgage, and sometimes there are lenders out there who do second mortgages. But I'm glad you made it clear here. Most hard money lenders going to say we're the first and probably the only mortgage on this property. You can't borrow any more money.
anybody who lends money just wants to protect it. And I think it's important as a borrower to understand what's important to lenders, whether that's hard money or private money for that matter. Understanding that people want to protect their money and knowing how it's protected. It's really simple to understand these things, what first position means versus second position, and how the mechanisms that do that. And like I can do it without with flunking out of college, my freshman year, right? Like I'm not a lawyer by any means. You can ask ChatGPT about these things and sort of understand them. So, but the second thing is character, right? I care about doing business with people that I like, that I want to go to lunch with, that I want to support their business and grow it. And so I'm interested in just working with people who have similar values that, I can develop a friendship with. And so that's another thing that I don't think that you get with banks. People wear suits and ties and, they go in there and it feels just kind of stuffy to me when I go to a bank. But Chad, when me and you go out to lunch and we just kind of shoot the breeze about things and how projects in your life are coming along, and we can talk about money or deals for 5-10 minutes and then move on to the other important things, that's meaningful. And
Yeah.
so I'm interested in working with people who have good character, and you can work with lenders who have good character too and find alignment in your values. But that really matters, I think. And there's certain things that you might be able to do with somebody, again, more creatively, because you've built that relationship that you otherwise wouldn't have. And another underwriting criteria or thing that we really look at and care about is cash in the deal. How much cash you have in the deal makes us feel safe. And again, that could be in the form of collateral for us, but a lot of times hard money lenders and lenders are looking for some skin in the game. I think as you approach any lender, whether it's a business or whether it's private money, being willing to put some skin in the game is an important criteria. And then having some good cash reserves where you feel safe is also a good idea. So, we're not wanting to do any deals with anybody, and a hard money lender is going to be aligned with making sure that this is a safe deal for you, because it has to be a safe deal for them, right? So they don't want you to really ride the edge of risk, and that's a good thing to know when you're approaching somebody who might be a little bit more seasoned in the investing game, can look over your shoulder, make sure that your scope of work is good, make sure that you have some skin in the game, that you're really going to make money on this deal and be able to do what you plan to do.
Yeah, and there's this mentality that I think I understand why people have it, of having no money down in every single deal. And it helps you grow. It's, you want to be aggressive, but I've actually made this comment on Twitter one time. I got a little pushback saying, if you're like 5 years into your business and you're still having to always put no money down, like something's wrong. Like you haven't been reinvesting your money. And by putting some skin in the game, I've asked lots of bankers, lots of lenders what their one of their first criteria are, and they like to see skin in the game because it shows you have something to lose. It shows you are aligned with the lender. You're on the same page. You have something to risk, and that's natural. That makes sense. And it might mean that you have more skin in the game. It slows you down a little bit. You do fewer deals because you have cash reserves. It might mean you can't grow as fast. That's actually a good thing. Like sometimes you have to say no to too many deals so that you can survive and actually see another day. So that's a little bit of a tangent, but I'm going to repeat your C's here just to remind everybody. First, collateral; second, character; and then what was our third? Have we got our third one yet? Cash in the deal. All right, third C. I like it. What's C number 4? Unless you have any other comments on that.
Well, I think it's those three are the main ones. The last one would be credit. Okay. Maybe
credit. Got it.
And so if you have good credit, you have a good job, that sort of thing, that can play into this. But some lenders don't even check your credit. It's not an important factor. Some do, and so credit worthiness is an important thing. But that doesn't. I would say those other three are really important when it comes to the underwriting, and knowing that what any lender is going to be looking at is helpful, I believe, for people to kind of be prepared and know how that relationship gets structured.
Like it. So we've been talking about benefits, and going back to this original scenario, and I actually want to get some case studies here in a second of other ways you can use hard money or the short-term money. But we talked about benefits. It's fast. It's easier to qualify. You have a relationship with someone. But it's not all, like every tool you have in your toolbox for financing has pluses and minuses. Yes. And so I want to just briefly talk about like the logistics of how a hard money loan would work on this kind of deal. So you get that 60% really cheap deal that you're like, I got to close on this. A hard money lender, you might talk to them, you might apply for the loan. They approve you pretty quickly. They come to the closing with a certain amount of cash. And in your case, Justin, correct me if I'm wrong here, but maybe let's say the number is $150,000 is the purchase price. Mm-hmm. Maybe I need to come with $15,000 cash. Is that a good number? Like 10% down? Would that be a typical scenario?
Yes, 10% down is something that we'd like to see as a minimum criteria. But we base those numbers based on the overall after repair value, the value of the property once it's fixed up. Okay. And so we would also include the rehab that might be needed for that property. Okay. But if you were just doing a purchase, so 150,000, we would loan 70% of that with you bringing 10% down. That's how we structure our deals, and that's pretty typical.
So 70% of the after repair value. So I'm going to test my math a little bit here, but if we had a $300,000 property, then you would loan up to like $210,000 max.
Yes.
But then out of that 210, so you would loan up to 210, but out of the purchase price, we'd have to come up with some of the money ourselves. So that mean would you loan less than 70% because we're putting a little bit down? Just make sure I understood that.
Yeah, it would end up maybe being about 63% once you put the money down. And then let's say the purchase price was 150, it needed, $60,000 in rehab or something. Then we would use that money as escrow and then have a draw schedule for you to give you the money over a period of time. so that you can do your rehab. And so the loan amount would be for the rehab plus the purchase price.
Yeah.
And that would require you to bring, 10% of that total amount, but that's all your skin in the game.
Got it. Okay. So maybe 20 grand, 21 grand total would be how much cash you put in yourself. But then because you have this lender loaning you the rest of the money, they're going to put some money aside. They're going to let you do a draw, meaning you get that money over time as you remodel it. And so the whole point of this, like, and the reason I'm wanting to have this conversation with you, Justin, is this block that some people have of saying, I've run out of money. And this is one particular solution. I mean, we're going to get into private money and a little bit of compare it to partnerships here in a second. But the big light bulb moment for me was knowing that if I have a good enough deal, I can go find some kind of money to pay for that deal. But it depends on the good deal. Like that's a whole nother conversation, but you got to have a good deal. So I want to, as we're looking at these tools to solve this problem that we're talking about, Justin, let's talk about some of the challenges or the things that might not be as positive as some of the other alternatives with hard money specifically. Like we talked about all the benefits, like what are some of the challenges as a borrower that you would see with hard money?
Well, the cost of the money is the highest with hard money compared to any other traditional route to financing. And so you're paying a premium on interest for the speed and the convenience and some of the flexibility that the lender has. And, typical terms end up being anywhere between 10, 11, all the way up to 16% is what we see. And hard money lenders structure those terms differently. So when you're shopping hard money loans, it's always helpful to just get a really quick term sheet or idea of how they like to do their deals. And they should be able to say, the interest rate is this, it's monthly payments, the points are this, and then any other fees. And you always want to ask.
Define points and fees. I'm interrupting you there again, Justin,
Yeah.
but just in case somebody's like, what's he talking about there?
So the interest rate is an annual interest rate. It's simple interest. So, 10% on $150,000 would be $15,000 in interest over 12 months, right? And then points is a fee as basically 1% of the total loan amount. So 1 point of $150,000 would be $1,500. So
Okay.
if I charge 3 points, then I'm going to charge $4,500. You want to know, is that point paid up front or is it paid on the back end? When is it paid? And then there's processing fees and all kinds of things that people kind of tack into their draw fees. We don't do any of that. We just charge the simple interest and some points, and we keep things really, really simple. But when you're comparing, like, say, my loan, which would typically be 13% and 3 points, to somebody else that is 12% and 2 points, then you want to ask the person who has 12% and 2 points, what other fees are there? Because sometimes those can be significant on the front end or the back end.
Because ultimately, as a borrower, what we're really wanting to know is, like, what's the cost total? Like, so you got to total up all the fees, the points, the interest. At the end of the day, you said it's like a 10% interest loan on $150,000 would be $15,000 for the year. But if your plan on a real deal is to hold it for 6 months, for example, you'd have half of a year's interest. So that was like $7,500 with a 10% loan. Plus you'd have to add the points in. So really, like, the math we have to do is just adding up all those fees to get some total cost of the loan, whatever that is. And then we can compare apples with apples at that point.
Yeah. The simple question is, what is your holding cost? And then you compare that based on the timeline that you're looking at. Another challenge, or, the way that these deals are structured, is that they're designed for short term. So the lender wants to turn the money into more and more loans. They're active in doing that. And so you can count on, loans being anywhere from 6 months to a year. Sometimes you'll go 2 years, but it's helpful to know that there's a time frame to this, and it's helpful to know and be confident that you can do what you need to do within that time frame that you agree to.
I want to add an asterisk on this, because some of the worst scenarios I've seen investors get into in real estate investing have been running into timeline issues with loans. Sometimes it's a commercial loan where there's a 5-year balloon on it, and they're like, oh, we're in the middle of a great recession. We're not going to renew your loan. Pay us $500,000 right now. Or it could be a hard money loan where somebody thinks they're going to like refinance this property into a BRRRR strategy where they buy it, they remodel it, they get it rented, and then they go to refinance and there's like some hiccups and they can't refinance it and they run up against the 6 month or whatever the deadline is. And now they're stuck. Like the hard money lender, if they wanted to press issues, could say, pay us now or we're going to foreclose and take this property back. So like, I guess that I'm just putting an asterisk there because not only is the cost of the loan really a big deal, but having a plan on how you're going to do this quickly enough and having a backup plan and another backup plan, like you can get caught there. That's a really precarious situation when you have to come up with a large lump sum of money all at one time. That's where you can get into trouble.
Right. So you want to see a deal. We want to do deals with people who have resources or who have enough margin of safety in that deal where we can think, okay, in the worst case scenario, you get to this point, it's going to balloon. Then number one, if you do everything that you say you're going to do, there's a decent chance that you can get an extension and get them to agree to those extension terms before you actually sign the loan. So, hey, I know I said I would do this in 6 months, but I really want some cushion. Can I have an option to extend for another 6 months? So in a project that might take you 4 months, you know that you have more time in case you need it. So that's something that you can try to negotiate with up front. But also, if you're really buying a 60% loan to value deal where you have 10% down and you have cash reserves beyond that, I think you can structure these loans really safe if you have the right approach to using the money safely. I think the folks who are flying by the seat of their pants and doing skinny deals and not putting skin in the game, Chad, or not having cash reserves, where they really get caught. So I think it's something to shore up on other levels, like whether it's your cash or how good of a deal that you're doing or other resources that you have that you can tap into. But if that's the case, you should be able to find somebody that's willing to either refinance this with another hard money loan if you had to, or a private money loan, and buy a little bit more time to get where you need to go. So most folks don't find themselves in that situation, Chad, that I see, unless they don't do what they say they're going to do, or they're not following fundamental business principles and doing some of those more dangerous things.
What would be an example of not doing what you said you're going to do? Would it be not communicating with the lender? Would it be like just lying? Like what are we talking about there?
Well, that would be absolutely. If you're lying and you're taking robbing Peter to pay Paul, meaning taking money from this project and then putting it over there, and not telling the truth, that's a big no. I would never do that. But that goes without saying. A lot of times people will have trouble maybe with a contractor on the front end. Perhaps they got the wrong contractor on the job. They're trying to save some money, and the draw money didn't go as long as it could have gone otherwise if they hired a contractor that was going to do what they said they were going to do. And so they're left holding the bag. And it's better to let the person that's lending the money know about these issues before it becomes a major issue. So if you did that and then you just kind of swept it under the rug and then dug a hole, that's not as good as going back to your lender saying, hey, I really need to adjust my scope of work and my draw schedule based on this. As soon as you have a problem, you want to think through the solution and go straight to the lender and communicate with them really effectively. And then that will smooth things over. Most lenders that are especially local, that are doing this based on the relationship, are going to work with you if you do that. You show the character that it takes. Things don't go perfect in the remodel world. That's for sure. As long as you can communicate that and understand, like, you have some resources to be able to come out of that safely, I think that's the thing that, we're looking for, not for it to go perfectly.
Yeah, I've had my own mistakes that I've made in my career. We've all have, right? And the times I can think of that went well, even though it started badly, were when I brought in my partner, my lender, whoever, early on, just like you're saying. Like it's I always call those sweaty palm conversations. It's like you feel like you're losing face. You're like, you were confident, they loaned money to you and they have confidence in you, and now you're having to go and like explain to them why something went wrong, and you think that might like lower their level of esteem for you because you made a mistake. But in actuality, what I'm hearing you say, and I agree 100%, is like every person who's accumulated some money, who has enough money to loan you, knows that things don't go perfectly. And they're not going to be like super happy about it. Like, oh, wait, I wish it would have gone better. But they're going to respect you for first admitting something's not going perfectly. Number two, for owning up to it and saying, hey, I'm taking responsibility.
Yes.
Here's how I'm going to solve this. Here's my plan. But here's my plan to solve it. But Mrs. Lender or Mr. Lender, I need you to do this to work with me, to help me. I
That's
mean,
right.
what a refreshing situation when somebody admits it, owns up to it, and then here's my solution. Can you work with me? Like that never happens. Like it's just very rare. So if you're that person, that makes a huge difference.
Yeah, right. Don't make excuses. And bring, try to have a plan to get the result that you said that you were going to get or close to it. Super simple and powerful. And I think what that would do is give you a +1 on your character, make that person want to do more loans with you, not less. But if you sweep it under the rug, that's
Yeah.
where the problems come out.
Yeah. Got it. All right. So I want to take a step back here. Like the purpose of this, you're going to find good deals out there, especially, hey, we're in 2024. The market's changing. The market's always changing. There's opportunities. Like the market cycles go up and down. And so this is one of the key skills that I know you learned, Justin, as an entrepreneur, as a small money investor, was how to come up with money when you don't have all the cash yourself. This is a key skill for me. Hard money lending is something I've wanted to unpack for a while here on the show, because it's not really understood as well, I think, by especially like newer investors. They look at those costs and they're like, oh, high cost, 10%, 12%, 13%. How could I ever do a deal? Like that's way too expensive, because I could go get a loan for 8% somewhere else. But I think what I'm trying to show here, and you're explaining really well, is that if you have a good enough deal, the purpose of the deal, this money, is to bridge you from the deal to like 6 months, 12 months down the road, just to get the deal locked up. And those costs that you're having to pay could be worth it if you get a good enough deal, because eventually you're going to refinance that property with a long-term lower interest loan, or maybe you're going to flip it if you're going to sell the property. So this is great for the BRRRR strategy, like the classic BRRRR strategy. This is great for the flip strategy, where you're buying, fixing it up, and selling it. But it's not the only source of money. So hard money, we've kind of unpacked a little bit here. It's a great source because it's plentiful. There's lots of lenders out there. But you and I personally have used probably a lot more, a couple other strategies, including private money and partnerships. So explain, Justin, kind of the juxtapose, show the difference between hard money and just getting a private money lender who pretty much does the same thing we're talking about here.
Yeah, that's a good question. It's very, very, very similar. But what I would say, the hard money is a local professional that's lending money as a business. And the private lender is typically lending money just as an investment sort of vehicle. And those lenders can be seasoned real estate investors, just like the hard money lender. But they can also be people that that are in your network, that are, people that that know other people. And they might not understand real estate as much. They might not be in the game as much, but they have some capital and they would like to get a good return on their capital, and they want to protect their money. And so those folks are, there's a lot more of those folks actually out there. And there's a lot more money in private money than there is in hard money by a huge order of magnitude. And I think that many investors don't understand that or believe that. And so they don't ever see it.
It's a little harder to unlock, I guess, would be my comment. Maybe you have a different idea there too, though. Is like there's a lot more of it. I mean, there's trillions of dollars sitting in like savings accounts and retirement accounts from individuals or wealthy people, but there's a gap, I guess. So with a hard money lender, you could call them up and within a day you could get all your application and have an approval for a loan. I mean, it's pretty quick. Whereas my experience, and I'll give a real story to kind of demonstrate this. My first private money lender, who really did a lot of loans with me, was a guy named Louis Stone, Dr. Stone. I've talked about him. He was a professor at Clemson University. I was a college student just trying to figure out what I was going to do with my life. And it took me like a year of getting to know Dr. Stone, of riding around with him and asking him questions, sort of as a mentor-mentee relationship. He was a real estate investor who developed properties, who owned rentals. He's kind of a wheeler dealer. He liked to do a lot of different things. And he also also taught classes in business at Clemson, which is how I met him. And he had to sort of vet me a little bit. He had to say, all right, who's this guy? I mean, I was 22, then 23 years old. You got to make sure this kid is actually serious, see what kind of questions he asks. And ultimately I had to demonstrate that I could follow through. And so I showed him eventually, after like a year of knowing him and building a relationship, I said, hey, I've got these foreclosure deals that I'm finding that the bank has taken back. I think I could buy it for about 60, 70 cents on the dollar, kind of similar to what we're talking about here. I can find these good deals and then I will fix it up. My business partner and I had a business partner and still do today. We're going to buy it, fix it up. We'll manage it. We'll fix it up and sell it. But I don't have the money. Like, could you put up the money? And I didn't know exactly how that would work. And that was the conversation that finally led to the private lender putting up the money for me to do the deal. But the point of that story I want to make is that, like, there's a sort of a skin in the game you have to have with a private lender, which is trust and relationship and getting to know them, and also really educating them. Like he was much more knowledgeable about real estate than I was, but he wasn't really knowledgeable about this specific tool, this specific vehicle. So I had to do some education to him about how it could work, how it would loan, what the paperwork would look like. And eventually I also educated him on some different ways to loan money. Like, for example, he used this retirement account to loan me money. And he didn't realize, he's like, his CPA said, no, you can't do that. That's illegal.
Yeah.
And I hear me, the 23-year-old kid, was like, no, I don't think it's illegal, because I'd done my homework. I'd studied it, and I wasn't going to put the CPA down, but I was like, let's have a conversation. Here's this company, here's this. And so I educated him and a CPA on the options and let them be satisfied themselves that it was a reasonable thing to do. And by doing that, I unlocked, $500,000 in loan available money that he then loaned to me over and over and over again for 20 years, Justin. Like, I just paid off my last loan with Dr. Stone last year with a little bit of sadness, because he and I both reflected on it. Like, I'd made him thousands and thousands of dollars. I'd helped pay his groceries in retirement.
Mm-hmm.
He had helped me get started in the business. He helped me grow. Like, it was such an amazing, mutually beneficial relationship. But the whole point I'm trying to make here is that it was not like a put the key in and unlock it in a day kind of thing. It was months to years to really build a relationship. Has that been similar for you, for like finding private lenders? Have you had to kind of slow dance a little bit before you actually do deals?
100%. Obviously, and shorter term loans are more helpful to do on the front end for this. And
Right.
having an opportunity that you have under contract where you can share some numbers, share actually what it is, that's the best way about going to do this. But it's, building a relationship long term. Like I said, going out to lunch and let's talk about business and our interest for a little bit, but let's talk about what your travel plans are this summer, and what are you going to do with your wife once the kids are back in school, and that sort of thing. And it's some of the best friendships that you can have are people that you can partner with this structure, meaning like it's super simple that people can understand, and it really solves some people's problems. Not everybody wants to lend out money. Not everybody understands it, but there's a lot more money out there that people have that's sort of lazy, that they don't trust their advisors, that they would love to have some sort of social impact in their local community, but they don't have a channel for that. And you can be that. You can be all of that. You can secure money. You can, have your incentives align with them, and you can make a social impact in your local community. It's like the best thing in the whole wide world is working with other people in that way. And it is a marathon 100%. Here's some kind of tips maybe for running that marathon. And I think that hard money can be a segue into understanding how to approach private money lenders, because it's so similar. So there's some overlap there. So you can understand the mortgage or the deed of trust, or how that gets filed at the courthouse, and a promissory note, and what those terms in there look like. They're pretty simple, but you want to understand what it is. And then you want to be able to explain to somebody, like on a 7th grade level, let's say, what they're investing in.
That's the key. That's the key. Yeah. Like even in this conversation, I mean, you've used some terms and I'm like, hey, like, let's bring that down to
Yeah.
the, it's such a challenge because sometimes we're in the business, we're talking vocabulary with other investors, we're kind of showing that we know what we're talking about, but with a private lender who may or may not, even if they are educated and sophisticated, you don't want to assume that they got this all figured out. You want to have this skill, and this is something I've been practicing for years of like, I like to, how I started my YouTube channel actually, Justin, was I started drawing out for private lenders. All right, here's the seller, here's the buyer, here's you,
Yes.
the lender. And it's all just like smiley faces, stick people like with little arrows
Yes.
here and there. It
Yes.
was like kindergarten. It was like kindergarten all over again, and like coloring crayons and stuff, and
It's
but that, man, that worked. That really like explained it,
it's
not in layman's terms.
it's super important to be able to explain what it is because people's guards are automatically up. And so it really has to be accessible. Hey, there's this house. It's at 123 Main Street. What I'm going to do is I'm going to buy that house. You would put up the money, but then we're going to secure your money at the courthouse with paperwork. So, Mr. Seller or Mr. Lender, if you don't get my payments every month in your mailbox, then you're going to get the keys to the house, and the house is worth 200,000, but your loan is only 100,000. See? And so you're just saying, okay, that's what I mean by secure. And so what I mean by secure, Mr. Lender, is that the worst case scenario, if you don't get paid, is the best case scenario for you. That's how I've
Yeah.
done this deal.
I used to tell the story. I would say, I hope I don't get run over by a bus, but if tomorrow I get run over by a bus in Clemson, and I hope you go to my funeral, I hope you shed a tear or two. But when you leave the funeral, I hope you realize that, I have a property worth 200,000 that I owe, that Chad owes me 100,000. So worst case scenario, I'm going to take this property back and make money. Like
Mm-hmm.
that's what they should understand, that kind of viscerally. And the perfect lender, the perfect private money lender is somebody who doesn't mind having that piece of real estate. That's a
Yes.
mistake I've seen people make. There's some people like, oh, well, this person has the money, but like they don't like real estate. They don't understand real estate. That's not who you want. Like Dr. Stone, my lender, he already owned property. He already knew property. He just didn't want to deal with all the details and the hassles and everything else. I was that vehicle for him to, in the beginning, make a 10% interest rate. That's to your point. Like I started with higher interest rates, kind of hard money like interest rates. But what's really cool is over time, as you build trust with that person, your
Mm-hmm.
interest rate literally goes down, like because the trust, as the trust level grows, the interest rate goes down no matter who you're working with, because you're becoming less risky literally with that lender. And by the end, I was paying 6% interest in an environment where market rates were probably 4 to 5%. I was paying 6%. And that allowed me to be able to hold rental properties. So like we've been talking about flipping and kind of BRRRR strategy deals. I was actually, throughout the Great Recession, able to use private money at 6%, paying interest only payments to buy like rental properties that I kept for 10, 15 years. And
Mm-hmm.
that was a huge unlock for me, Justin, was knowing that private money was a longer time horizon, potentially, not always, but potentially with the right lender, with the right trust, with the right relationship. I did 90% of my deals with private money lenders instead of hard money, instead of commercial lenders. So it's worth it. It's worth the relationship building to be able to do that, because it really unlocks a lot of other deals that you might not be able to do otherwise.
Right. I agree 100%. And it's so helpful to know how to get started. If you're, you know, creating the problem for yourself where you have more deals than you have money, good job. And if you have to use hard money, great. But the next step, I think, Chad, is to do a short term loan with somebody else that might have some, like when you have a deal, present that to your network. Folks who say, oh, I'm so interested in what you're doing in real estate, but how do you deal with leaky toilets and who manages it? Right. So that's kind of a really good indication that they're interested in you. They're curious about what you're doing in real estate, how you're doing it. And you can ask them questions back like, oh, do you not invest in real estate, or have you thought about doing that? And then, get them to open up about what they like to invest in. What do you like to invest in? Oh, I just put my money in CDs and they're 5% returns. Are you happy with that? And then try to make it super simple on the first deal when you do a private loan with somebody. And it's helpful to structure it similar to what a hard money deal would be, I think. Meaning it's hard to ask for somebody to get in bed with, to marry you, let's say, for 10 years or 20 years and not really know what it is that they're investing in until they do it. So we just can't overstate how you have to communicate it simply, but then on the first deal, it's almost like a trial for, what this investment is like, and see if they like it. And then they'll get used to getting monthly payments. Maybe you do a deal for a year, you refinance them out, you give them their money back, and they're going to think, I don't want my money back. Like, keep it. That's usually what happens. And to your point, the way that the marathon of going into single digit private money capital happens is by making it easy on the front end and doing deals with that are based on this relationship, but then putting maybe even a lot of skin in the game too, to make sure that their money is protected. Because something that people think, that you might think that a hard money lender really just cares about the return. That's not true. A hard money lender, people who are lending money, the thing that they care about is protecting their money. That's like the number one thing. And the return is never above protection of the capital. So it's always protecting the money above the return. There's no speculation or anything like that. And that's what makes it a good partner for people who are building, because they're willing to leave the meat on the bone for the person that's building. But then once you do that and you show that you have skin in the game, and you've done a deal and they understand what it is, the second deal, the third deal, the fourth deal, the terms get better. They get longer potentially. The interest rate goes down. Maybe you have less money down because they trust you. They trust what it is. Yep. And so all of those things can happen if you approach it as a marathon like you have. And I've learned from you on this 100%. And I didn't know anything about anything when it came to using other people's money, and I was terrible with money. But over time, as I started to, understand what is a note, what is a mortgage, how does this thing work, it's really simple, turns out. And I can, partner with other people to do it. It's my favorite way to do real estate deals with people.
Me too. It's so satisfying on multiple levels. And you've done an amazing job too. I've told some of my own stories, but the thing that's impressed me, Justin, not only you're now in the business of, you have rental properties, you're loaning out money as well, but you built your portfolio on these relationships. Like you took it seriously. Like you were the student who like listened and did it, where you built relationships with a small and mighty group of people, some of them friends, some of them, new acquaintances, and you just took care of them, and you did exactly what we're talking about here. Let's do a hard money loan first. I'll pay you off. We'll do a second one. Now they feel comfortable with you. And then you were able to buy small multifamily properties. You're able to buy single family houses. You're able to increase the amount of money that these people loaned you. And in both cases, you and I both were able to get long-term private money, like 10 years, 7 years, 15. I got 15 years where private lenders tied their money up with me for that long. That's, if you tell people out in the real estate world that that's possible, that no, private lenders don't do that. Like, well, of course they don't at first, just like, nobody just agrees to it right off the bat, but it's a relationship. So I think maybe that's the takeaway here. If we kind of step back again, hard money lending, really great, it's unlimited source of capital. You can do as many deals as you want. There's lots of private hard money lenders out there. Private money, also a huge opportunity. It's going to take you longer to get in there. It's more of a late relationship game, but it unlocks an enormous amount of horsepower for your business, but also satisfying. Like, these are your friends. These are your connections. These are people you're taking care of. You're making them money along with you. So I hope people just take those two seriously. We're just going to briefly mention one other option that I touched on earlier that I've actually done other videos on recently, on partnerships. And it's sort of a cousin to hard money lenders and private money lenders. But for me, it was a sort of an offshoot. Like, depending on the deal, there were certain deals where instead of me borrowing money, so using debt to quote partner with someone else, where they loaned me the money, they were the bank, I was the borrower, there were certain cases where just the deal made sense. Often it was a larger deal, or it was a longer term deal where there's less cash flow up front. And so I needed somebody to be flexible on the cash flow and take no cash flow or a little bit of cash flow now in exchange for more profits later. In those scenarios, having a partner made more sense. So either like a joint venture partner, where we have one property together and we have some kind of contract or agreement on how we're going to split the profits and do that, and just wait for the property to grow. In other cases, forming an LLC, having an operating agreement, and then doing a partnership that way is sort of, I see private money as sort of a gateway to some of these partnership deals. They might be the same person, they might be different people, but that's how it's worked for me. Is it's like this toolbox, and you've got all these different tools: hard money, private money, partnerships, conventional loans. You put all of those in there, and then you take them out depending on the deal. Has that been similar for you, Justin, and how you see the difference between those three tools?
I think, yeah, having multiple tools in your tool belt. I do have some rules. One rule about partnerships I have is I never partner when I can hire. So if I can hire that person, I don't really, I mean, it needs to be a good, long-term relationship
Yeah.
and, have the exit thought through. Also, in light of this conversation, I would also add most of the time, I wouldn't partner if I could raise the debt. 9 times out of 10. There
Yeah.
are deals out there where it's a bigger deal. I want to feel safer and I would rather give up more equity potentially. But if you're looking for, it's kind of like, be careful what you're looking for. If you're looking for a partner, sometimes a partner is wanting to have 20% returns, 30% returns or something like that. They care about the internal rate of return. And I think the avatar of the private money lender out there, what they care about really is protecting their money. And if you're not looking for that person and you're just looking for the person who wants outsized returns, you're going to have to buy a lot more real estate. And so in order to focus, it's easier to partner with people and simpler to partner people as debt. That's just my
Yeah.
opinion. I think other people could, make a case against that. And I've definitely have done great partnerships with my partners that have done things with me. Like, don't think that I don't love you. I'd love you. But it's a good rule to follow as you're trying to sort of build a small and mighty portfolio. Try and keep it small, keep it all.
Yeah. I think that's my hierarchy as well. If I can borrow the money or hire somebody instead of partnering, I would do that as well. I think that there's one particular deal I've seen a lot lately, Justin, is this, there's a tendency to buy growth oriented deals or growth markets where just literally like the cap rate or the cash flow on a deal is just, it might be 5%, 4%, and so if your cost of money, even with a private lender, is 6%, 8%, 10%, like the only way like possible that you're going to be able to get them a return that makes sense is some kind of deal where they're waiting on some of their money. And
Yeah.
so there have been cases where that makes more sense. Also, like credit partnerships where maybe the equity partner goes and gets the debt. They borrow like a long-term fixed mortgage and they put the down payment. Those make more sense to me too, because they're bringing something to the party that's kind of hard to hire for. Like it's hard to bring somebody, you might be tapped out on the amount of long-term debt you can get, and you're tapped out on the down payments you can get, and there's not enough cash flow in the deal. Like that's a very particular scenario. But again, like I'm with you. Like if you can keep your life simple and just borrow money and have a debt structure, that's always, always, always my preference too. And that's also like what, like my Dr. Stone, like it was, we did debt deals. Like he loaned the money, we borrowed the money, we owned the property. He was the lender. He had his own rentals over there too. He could do those separately, but it kept it so clean that the scenarios are really simple. It made our life a lot easier.
I love it. And it's way more accessible than people think. Real quick story about Aiton, who's in our RPM community. He had a goal. He didn't realize what, his quarterly goal should be. He thought it was going to be to get his next deal, decided he needed to do a soft raise of private money. And that's what the skill he was going to focus on for the quarter. So he makes this quarterly goal. I'm going to raise $250,000 and private money and a soft raise this quarter. And he does a event because he didn't have an event in his local community. So he hosted one. And within like 30 days, he was able to raise that amount of money from like 3 different people. So once you start taking action on this, it's a lot easier than you think, as long as you have conversations with people. So yeah, I just wanted to share that because people are doing this all the time. And RPM, it's a key goal that folks have to solve for the needs that they have on the money side. And, there's a simple way to approach that.
Shout out to Aiton. Great job creating your own event, raising money. I love it. And there's so many creative ways to do this. So I hope people take this to heart. The point of this whole episode has been thinking outside the box to raise more money for your deals when you run out of cash yourself. Like, don't let your small and mighty financial freedom goals always be limited by just how much cash you saved up. Like, that's important. Like, you need to save up cash, but there's the reality is the deal flow is not going to come in this perfect little sequence of deals exactly when you're ready. It's going to come when they come, and you can't turn that flow off at the same time. You got to have these other sources of money. You got to have this toolbox. And Justin, thank you for being here. You're one of the best, most knowledgeable people on this subject that I know. You've demonstrated this. You've done it yourself. You've raised private money. You're also loaning hard money. So I want to give you a chance, like, give a shout out to everybody about what you're up to, where they can connect with you, and any of these links that you talk about, I'll put in the show notes, and I'll put them in the video and podcast description as well.
Yeah, absolutely. I just have a quick giveaway to anybody that's listened to this, and so grateful to be on the show here, and grateful to be a part of the community and doing this with you, Chad. But if you go to www.lenderscollective.com/resources, there's a couple of checklists. A checklist for those of you that need a closing checklist for closing a deal that you're buying, and then a checklist also on the lender side. So we lend out money. That's our main thing. I love it. It's a business that I get to partner with other folks on. I get to see outsized returns on our money. So if you're interested in that, or you need a resource as far as a checklist goes, and you're thinking about lending out money, you can have a give me there and reach out to us from there.
Awesome. All right. I'll put a link to that so you can get those checklists. I'm a sucker for checklists. I have so many of them, and I like borrowing from other people. Like, why reinvent that wheel, right? When you got somebody else who has a checklist.
Yeah.
So,
That's one of the things I like to highlight about RPM. I like to tell people there's like so many checklists in our swipe file in RPM. It's not something that we feature on the website, I think, but it's one of the big gold things that's in there. Yes. Yes. And I like to tell people it's written in blood, man. Those checklists that Chad has, they are written in blood and sweat. So
yes,
use
every
them.
mistake you make, you add another check to the checklist. So love it. So I will put links to all that in the podcast description, the YouTube description. Justin, it's been a pleasure. Look forward to talking to you some more soon, and have a great week.
God bless. Thanks, man.
Thanks, Justin. In this episode, we talked some about formulas to analyze good real estate deals. And one of my favorite formulas, one that I use on every single real estate investment, is something called the internal rate of return, also known as the IRR. In my next video, I show you how to use internal rate of return to evaluate your investment properties. And I also give you a free case study and a free spreadsheet that you can use on your own. If you're watching on YouTube, you can just click on the thumbnail above me here, or you can click on the link in the YouTube and the podcast description below. I'll see you in the next video.